Time's expired. Gentleman yields back. The gentleman from Georgia, Mr. Scott's recognized for 5 minutes.
Thank you very much. First of all, Chair Gensler, I agree with our ranking member, Ms. Waters. I believe you're doing an excellent job. Excuse my cold. An excellent job at a very difficult and challenging time facing our economy and especially our securities markets. On July 12th, my good Republican friend, Congressman Frank Lucas, and I sent you a follow-up letter with respect to the SEC's proposed rule regarding the impact of publicly disclosing proprietary positions in large security-based swaps above certain reporting thresholds. And specifically, Congressman Lucas and I, we raised concerns with how this move could impair market liquidity and hinder the SEC's core mission to maintain fair and orderly and efficient markets. So my question to you is, first, I know you have previously said you understood the law to require some public availability of this sensitive information. But can you expand on whether widespread public access to large SBS positions could in any way impair the ability of market participants to operate their trading business or limit their ability to hedge effectively?
We continue to consider at the staff level, at the commission level, not just your comment letter with Representative Lucas, but others about this. But securities-based swaps can be used to basically replicate the positions that are taken in the stock and bond markets, but particularly in the stock markets. And you might recall about 2 years ago there was a family office called Archegos that did that, and did that in quite some size. So that's one of the reasons, not the only reason, but one of the reasons. Just we look at this and we say, Congress gave us this authority. This is one of the remaining authorities we had not addressed from Dodd-Frank. And so we took it up. We put a proposal out about the possible requirements to report to the commission, and then in some cases report publicly these large either credit default swaps or total return swaps that, of course, credit default swaps were at the center of the 2008 crisis, and total return swaps were at the center of this one example, this Archegos example.
Yeah, now let me ask you this question. Do you see any risk in allowing the public to take advantage of this information, for example, by facilitating front-running and copycat trading, which could drive up the costs for all market participants?
I believe we've gotten that comment from a number of commenters. It's taken up in our economic analysis. Excuse me. Taken up in our economic analysis, but it's an important issue of all public transparency. The markets can benefit from transparency, but sometimes there's somebody that had an advantage of the opacity. So when I was on Wall Street, we used to have a saying a little bit at the firm I was at, that darkness was our friend. And it was about sometimes opacity helps make more money as a dealer, but it's not necessarily the case that the markets themselves, economists tend towards the transparency helps the proper pricing in the markets and also helps capital formation.
Well, I'm delighted with your presentation. I understand with the little economic and finance that I handle at times, particularly with the stock market, Keep up the good job. Don't get discouraged. We'll get out of this mess in our financial markets.
Gentleman's time.
Thank you.